I was really really surprised. And I was surprised simply because there is people I came across and they told me the only thing they need is indicators. They only need indicators to become profitable. And so guys, these people are beginners in the industry. It's very hard to convince those kind of people that indicators will never make them profitable. So they asked me a platform that will basically help them assess as many indicators as they can. So I told them, just try tradingview.com. So guys, don't you believe you can make money without using any indicator? Don't you believe you can actually be a profitable trader without using indicator? So guys, in this video, I want to demonstrate something really simple and something you will never ever see many indicators plotting. We have thousands of indicators showing us order blocks, thousands of indicators showing us fair value gaps, and when you use them, sometimes you come to realize you're losing a lot of money. Why are you losing money? You're losing money simply because the indicator is actually number one, plotting those fair value gaps or order blocks wrongly. So guys, in this video, kindly let me show this method that you basically need no indicator for you to become profitable. So guys,
we're going to talk about the breaker blocks and how you can use this concept to improve your chart analysis. We will explain what a breaker block is, the psychology behind them, and why they work, also how to identify and trade them. Now, what is a breaker block? A breaker block is a failed order block that turns into another supply or demand area on the chart. From basic price action, we know that whenever the price breaks through a resistance level, it becomes support due to behavior of market participants. Similarly, whenever the price breaks through a support level, it becomes resistance when market taps into that area. Again, the same concept applies to the order blocks as well. The market could ignore the order block supply and demand for many reasons, including a shift in market structure being overvalued or oversold, tapping into higher time frame key levels, and more. When a valid demand order block fails to reject the price and the price breaks through, it becomes a supply level. We call it a breaker block, expecting that the market will reject this area. So right here, this is what a bearish scenario might look like. We have a break of structure above this higher high with inefficiency. So this move creates a valid order block zone that can provide us with an opportunity to go long. However, the market makes a change of character caused by this aggressive move breaking below the previous low. As a result, the directional bias has changed to bearish and our demand level will turn into supply after this break occurred. The psychology behind the breaker blocks is that the traders who got long in the order block are now trapped after the bearish market structure shift. So they would want to wait for price to get back to their break-even spot where they can close their longs for no loss. Also, traders will go short here since they see this area as a key area of supply. The outcome of this double action is what makes the price reverse from this area. So one of the key points here is that a breaker block forms when we have a run of liquidity before a market structure shift. The same goes for a bullish scenario. We want to see a liquidity run below the swing low before a market structure shift higher. Then we mark the candles that created inefficiency and extended in time, which is going to be our breaker block, and we expect the price to reject that area. Here on the Euro 15 minutes chart, we had a strong bullish move that created inefficiency and broke market structure. As a result, we have a valid order block, which is a great demand level to go long. However, the market suddenly changes direction and breaks below this demand level with large candles. This change in direction could be due to the price tapping into a higher time frame resistance level. As you can see on the 1-hour time frame, but on the 15 minutes chart we see this move as a liquidity grab above the previous highs. We now have a bearish market structure shift and the area of demand has now turned into supply. Therefore, we expect the price to be rejected from this breaker block and continue to move downwards. Here on the USD 30 Canadian dollars minutes time frame, we have identified an order block creating inefficiency and a break of structure. However, the market breaks this demand area showing a bearish market structure shift. As a result, the demand turns into supply, and if the market taps into this area, it will provide us with a potential short opportunity. Now, let's discuss some of the key factors that you need to consider while trading breaker blocks. Let's continue with the key factors. Number 1, market structure. You need to identify the current market structure before looking for breaker blocks. Market structure includes defining market direction, supply and demand areas, higher time frame, key levels, liquidity areas, and amount of the space we have in front of the price. Number 2, validity. Make sure the breaker block you identify is valid. Breaker blocks are created by a run of liquidity before the market structures shift. Look for a sharp move with fair value gaps between the wicks that creates inefficiency. Number 3, confirmation. Wait for confirmation before entering a trade. Confirmation can be in the form of many price action signals. Here, shrinking candles show that the price is losing momentum while approaching to the breaker block. Then we have a long wick candlestick strongly rejecting the area. Following, we have a change of character, confirming the direction change and signaling a possible reversal. By keeping these factors in mind, you can effectively trade breaker blocks and increase your chances of success. Like with other trading concepts, breaker blocks should be used in combination with other forms of technical analysis to make well-informed trading decisions. For example, here on the New Zealand dollar 1-hour time frame, the market made a bearish change of character by breaking below this swing low. We have this bullish order block turning into supply now. And also this move has created another bearish order block. So either of these supply levels has the potential to reverse the price and make it push downwards. But a more conservative way to enter the market would have been to trade the order block and place our stop above it. Remember that as a trader, our job is not to predict the future, but to prepare ourselves for different scenarios that might happen. And that's bring us to the end of this video. Don't forget to subscribe, like and share. I will see you in my next video. Listen traders, before you make any big mistake, like paying for that expensive course, try reading this book first. This is basically what you are going to be taught by your mentor. In fact, not even everything. If you are a beginner and you have learnt only basics, don't dare funding your Forex account because you will not like the results. This book will introduce you to another side of Forex trading because you cannot like forever buy at support and sell at resistance. This book comprises of everything you need to know about smart money concepts and price action, and everything is explained simply. Grab your copy at $10 only and it will save you from a lot rather than paying for those so-called Forex mentorship. You can make payments via PayPal, Binance USDT, M-Pesa and SendWave. Look for payment details on the description of this video. Send your receipt and you will get your copy. First come, first serve.